Hello, everyone. Welcome to our Juneteenth Learning Lab. Today, we have a very special guest with us that will be talking to us about finances, a big place in which a lot of us struggle. I know I personally have had struggles with my finances and trying to find ways that would work to manage our personal finances, our business finances, and to continue to grow those businesses. I know, within the Black community, a lot of some of my personal friends have gotten really big in the business and helping people to learn about how to manage their finances, about the your credit scores and learning about business credit scores and things of that nature. But not a lot of people are talking about um, um, investments, right? How do we invest the money that we do have so that our money can grow for us outside of what we are already working on, as far as our 9 to 5 businesses, as far as our entrepreneurial businesses? How can we still continue to grow our finances? So we will be bringing Shamba on in a little while to talk to us about that. But before I do that, I wanted to introduce myself. For some of you that do not know me, my name is Athenia Rodney. I am the CEO and founder of Umoja Events, and I am the co-creator for the Juneteenth NYC event that has been happening currently for the last 12 years. And next year will be our 13th year. Yay! So excited. We had to, like most businesses, we had to pivot and do an online version of our event this year. But we had so much success and so many things have come together for us that we are now seeing, play out for 2021. So for next year, we want you to put on your calendars June 18th, 19th, and 20th. We will be holding a Juneteenth summit. So it's something that's new. We're always trying to step up and see how we can change the game and do things a little different than everybody else is doing. Since we have been doing this already for 12 years, we wanted to do something a little different. So on Friday, we're doing health and wellness. On Saturday, we'll continue to have our Juneteenth Festival. And on Sunday, we have a new addition that we have added to the platform, which is called the Juneteenth Pomp. And that is a pageant for teens, for males and females who are interested in entrepreneurship. So if you have a young person who is interested in entrepreneurship, we are looking for them to be able to participate. We will have a number of programming available for them leading up to the Juneteenth day. And on Juneteenth, they will be basically presenting their business to the community. So very much like what you've seen as far as beauty pageants. So there'll be some touches in the beauty segment of it, but we will definitely be focusing on entrepreneurship. And as you already know, every month we do what's called a micro lab. So we usually do it around the 19th date to kind of stay in line with our Juneteenthism. And so we do this micro lab with different topics that you have expressed that are important to the Black community. So we want to continue to bring different topics of discussion that's relevant to us that we can continue to talk about. And then lastly, we are doing a week of Kwanzaa where we will be looking for vendors to be able to showcase their products and on our feed. So we'll be doing that throughout the Kwanzaa week, which starts December 26th and goes until January 1st. So we hope that you'll continue to follow us and on our journey through all the different things that we have going on. And please look us up, on JuneteenthiNY.com. All right, without further ado, I am going to bring on our speaker for today. Let me see if I can find him. Hello. Hi, Shamba. How are you?
Hello. Doing well. How are you?
Good. Well, welcome and thank you so much for joining us. I know this is a new platform for some people utilizing StreamYard. But it's definitely been a great platform for us to be able to share with the people, to connect with people. And we want to definitely welcome you on board. To start, I guess, can you tell us a little bit about who you are and what you would like to share with us today?
Sure. Well, thank you very much for having me. If there's anyone who's having difficulties seeing me, I apologize. I know a thing or two about finance, but tech is not really my thing. But thanks again for the invite. You guys are doing great work and glad to join. So, my name is Shamba Sandy. I am a Brooklyn native. I'm actually a Trinidad and Tobago native, but I grew up in Brooklyn, New York. Went to elementary school, middle school, high school in Brooklyn. Then I attended Morehouse College. So I was in Atlanta for 4 years. After Morehouse, I got involved in finance, and that's what I've been doing for the last 15 or so years. I've done a few different things. Immediately exiting school, I was a CMBS trader, a commercial mortgage-backed securities trader. I did that for a few years, and then I became an investment grade corporate bond salesman. And I did that for a longer time. And for the last 2 years or so, I've been in asset management sales. So I help institutional clients manage their excess funds.
Oh, sorry, I was on mute. That sounds awesome. And you are an a Morehouse. I went to Spelman for a spell, so that is very exciting to know that you're my brother company, brother and sister company for sure.
Absolutely.
Hey, and we have June Grayson on. Hi, family. How are you doing? Thank you for joining us today. So I still have not been able to get this PowerPoint presentation. I am not sure why it's not pulling up. So as you said, we are having some technical difficulties today, but we will not allow that to steal our show. Shamba, do you want to get started while I try to pull this up maybe on another line and see if I can get it on fast?
Yeah, I'll get started. And considering there's no presentation, if there are any questions, feel free to interrupt me and I can answer questions as we go.
Sounds good. We'll do.
All right, so awesome. Like I said, I've been in finance, specifically sales and trading, for about 15 years or so. I know a decent amount about the markets. I know the power of the markets, the ability to create wealth using the stock and the bond markets. And unfortunately, it's something that people like us don't really get to take a part in. So I'm glad to participate in this. So why are we here today? Hopefully, when I'm done, everyone on the line will have a better understanding about the financial markets, the role that it plays in building wealth, and how to attain some wealth and how to manage it once it's been attained. So when I was asked to do this presentation, I was thinking about a couple quotes that speak to me in terms of wealth and money and inheritance and so on. So I came up with a few that I'd just go through very quickly. One of them, maybe a lot of people on the line know fairly well. It's our good friend Kanye West. This was Kanye West before he went crazy. That said, having money isn't everything, but not having it is. And then there's a quote from Henry David Thoreau who said, "Wealth is the ability to fully experience life," which I totally agree with. And then lastly, a quote from Malcolm Forbes who said, "I made my money the old-fashioned way. I was very nice to a relative right before he died." So those are some quotes that I wanted to throw out there. So first and foremost, let's talk a little bit about measuring your financial health. There are a few different ways to earn money. A lot of us are very familiar with the common way, which is wages and salary. That's payments that you receive for showing up and doing work at any given day. You're an employee of an employer, and you have very little control over that money because whenever your employer sees fit, they can decide to get rid of you, and that stream of cash is gone. So that's when you use your physical and your mental assets to earn wages. The second type of earnings are when you use your wealth and your monetary assets to provide some income. So that's, let's call it investment income, and then also investment income from when you have an abundance of wealth, and when you have an abundance of wealth, you can put those assets to work. So again, what are we talking about when we say wealth? We're talking about an abundance of valuable possessions or money, and wealth comes from having a high net worth. So if you move on to the next slide, how do we define net worth? And net worth is, we define it as everything you owe, everything you own minus everything you owe. So again, I was, thinking about putting together this presentation, wanted to come up with some stats to make it a little bit more tangible. According to the Associated Press, the average Caucasian household has a net worth of just shy of $200,000. The average African-American household has a net worth of about a tenth of that. So that means if your average Caucasian household decides to, I'm going to quit work and just go off and live, or it's an unfortunate event and someone passes away, they have just shy of $200,000 to either live off of or pass on to another generation. With us, it's only $24,000. And that's a big difference. You give someone $200,000, they can buy a house somewhere, live off of that for the rest of their life, at least live, not have to pay a mortgage or rent. You give someone $24,000, they can probably pay for a semester of school, and that's about it. So it's a big difference there. Why the difference? Of course, we all know about challenges over the course of our time in this country, from slavery to Jim Crow and everything. But bringing it up to recently, one of the reasons why there is that big gap is because Black folks tend to be a lot more conservative. We don't invest as much. And when we do invest, we kind of, we put our money under the mattress, or we put our money in the bank, and we call that an investment, as opposed to, investments that really provide some return. So another stat, only 33% of African-American households own stocks. 61% of white households own stocks. So again, that's part of the gap and why there is this gap in net worth. So if you move on to the next page, we can start talking about building wealth. And again, I'm not Warren Buffett. I'm not Jeff Bezos. I haven't had that level of success, but I've been successful enough where I think I can share a thing or two about building wealth and how to invest that wealth. So a lot of people think wealth, and the first thing they think is, okay, I've got a high salary. That's great. Or I make a lot of money per hour. That is great. I'm not discounting that. But again, what good is that salary if you were to be fired or laid off today or tomorrow? A high salary means nothing if you haven't saved any money from that high salary. So building wealth isn't only about your wages and your income, but what you do with it. So first and foremost, you obviously want to save money from your salary. That's a good place to start. Once you get beyond that, you have to think about investing. We want to buy assets that appreciate instead of buying assets that depreciate. And we also want to buy assets that provide some type of income. So you think dividend payments from stocks, coupon payments from bonds, other payments from limited partnerships, and so on. So one of the best ways to build wealth, which is not a very sexy way, no one talks about it, but it's your 401k. A lot of employers offer some type of match for a 401k. So if you are getting a 50% match in your 401k, for example, that's automatically a 50% return on whatever savings you have there. So if you're fortunate enough to work at a company that matches your 401k, you put $10,000 a year into a 401k, you get a 50% match. That means you have $15,000 in your 401k for that 1 year before market returns even. So if you have $10,000, if you save $10,000 and put that into your 401k, the company matches at 50%. And then on top of that, let's say the market goes up, let's call it 20% that year. Your initial 10,000 savings into that 401k becomes $18,000 at the end of the year. That's an 80% return. You don't get those returns anywhere on any type of safe investments. And a 401k is a relatively safe investment because your company's only going to allow you to invest into, honorable and decent investment funds and so on. So again, 401k is a great place to start when it comes to building wealth. And if you think, let's just use simple math here. Let's say you do that for 10 years. That's approaching $200,000 that you would have saved in 10 years. That is not a small amount of money. And when we talk about the average net worth of a white family versus a black family, we just said the average net worth of a white family is just shy of $200,000. If you were able to get this 401k match for 10 years and you have $200,000 at the end of those 10 years and you plan to work for, let's say, 30 years or so, just follow the math to see where you can end up. Another way to build wealth is owning the place where you live. Real estate is an example of an asset that tends to appreciate versus, let's say, a car or clothing or something like that that will depreciate. So you're going to fork out cash anyway for somewhere to live. Why not spend it in a manner that can be redeemed, right? You're going to pay rent anyway. A mortgage payment is basically rent, but rent that you are going to get back once you sell that property. So again, if you are able to buy a house, and there are a lot of programs out there for first-time home buyers. When I bought my first house, I qualified for a first-time home buyer loan. I believe I put 3% down, which is just amazing. So there are programs out there for first-time home buyers. Once you buy a house, you pay the mortgage for a few years. Let's say you want to move or you're just ready to sell the house or something along those lines. You pocket all of the appreciation for that house along with all of the loan payments that you have paid back. So let's say over 10 years, you paid, just again, for simple math, $10,000 down in principal. At the same time, your house, your $200,000 house has appreciated by 10%. So that $200,000 house, when you sell it, you now walk away with $30,000 because you've paid down the principal by $10,000 and the house has appreciated by $20,000. So again, real estate is a great way to build wealth. It's also safe. It's one of the safer investments because it's tangible, and there's only so much land in the country, and there are only so many houses in the country. So real estate usually has a good bid to it. So again, continuing with building wealth and real estate, according to the Census Bureau, the average net worth of a homeowner is about 80 times that of a renter. And again, these are facts. This is me coming up, making things up. These are facts that I've researched. Real news here. So the average net worth of a homeowner is about 80 times that of a renter. And that's because as a renter, you're writing that check every month and that money just goes away. As a homeowner, you write that check every month and you actually get a portion of it back along with the appreciation of your house. So again, just to run through that example, a typical homeowner takes out a 30-year mortgage to buy a $200,000 house. After 30 years, that mortgage is paid off. They no longer have to pay for housing. They can live there for perpetuity and not have to pay anything, or they can sell their home and they can get back that $200,000 along with inflation. Real estate prices are impacted by inflation. So again, a $200,000 house after 30 years of inflation, we're probably talking upwards of $400,000. So when you buy real estate, you're taking out a loan for a fixed amount. to purchase something that will increase in value. So basically, your liability goes down while your asset goes up. And that's why after 30 years, for example, your initial investment could be worth upwards of $400,000. Excuse me. So, and again, sticking with real estate and the price action that we see in real estate. In 1988, the Case-Shiller Home Price Index, which is the index that Wall Street and the government and everyone uses to track home prices, stood at 68. Today, that same index is at 220. So on average, the price of a house today is worth 3 times as much as it was worth in 1988. That's real wealth. You buy a house for $200,000 in 1988, it's worth $600,000 today, and you've paid off the mortgage. That's like a win-win-win-win-win. Whereas if over those 30 years you've been renting somewhere, you get nothing back at the end of those 30 years. So let's talk a bit about managing wealth. Once you've accumulated wealth, whether it be via 401ks, savings, real estate, whatever, what do you do next? I'll start by talking about some of the things that you don't do. You don't bet the farm on risky investments. You don't take on too many illiquid investments. You don't take on unproven investments. What you want to do is you want to diversify your investments and work with people that you trust. Why do you not want to take on too many risky investments? Easy. If it's taken you 30 years to accumulate this $500,000 or $600,000, why do you want to make a bet that can see you lose half of that in a year, right? So you don't want to swing for the fences. You don't need to hit a home run. If you hit 4 singles, it's the same outcome as hitting a home run. Again, you want to diversify your assets. And unless you have some type of serious expertise in investments, you want to stick to vanilla investments. Vanilla investments are easier to understand, which means it's harder for you to lose your shirt on them because you typically will understand what you're doing. So what am I talking about when I say vanilla investments? Stocks and bonds. What is a stock, right? A stock is a portion of ownership in a company, and you are entitled to your share of all profits after all debts and all expenses are paid. Fairly simple, or as simple as an investment can come. You own a portion of something, and when there's a profit, you get a piece of that. What is a bond? A bond is an IOU from a company that must be paid back before any of the stockholders get profits. So again, fairly simple. Someone has an idea. They need capital to make this idea work. And they say, you know what? You loan me some capital and I will pay you back, a fixed interest rate until I can pay back this debt in full. So those are your 2 most vanilla investments, stocks and bonds. On average, over the last decade, again, this goes back to how I started. The financial markets are just a great way to build wealth. And there are some people who have not lifted a finger in this life and have gotten really, really, really wealthy just playing the stock market. On average, over the last decade, the stock market has returned 260%. Now, that's just using the broad measure of the S&P 500, which is a broad index of I believe it's domestic only companies. So if you invested $1,000 in the S&P 500 10 years ago, you'd have $2,600 today. From $1,000 to $2,600, having not lifted a finger at all. So what are some of the pros about the stock market? As that example shows, unmatched potential for growth. There's nowhere else that you can, or few places that you can experience the growth of an asset like you can with the stock market. Historically, the stock market over long periods of time always go up. And the stock market is extremely liquid, extremely liquid. So and what do I mean by liquidity? You invest money in the stock market today, and tomorrow you decide, hey, you know what? I cash back, or I just want my money back. T+3, you sell those stocks and you get your cash back today plus 3 days. No haggling over what it may not be worth. The stock market is extremely, extremely, extremely liquid. What are some of the cons about the stock market? It's volatile. Granted, over the long run, it always goes up, but there's some up and down on that up trajectory. There's also no agreed upon formula for what any given stock or what the stock market should be worth. So some people say today, stocks look cheap. I like the stock market. Some people say stocks look rich. I don't like the stock market. Who knows who's right? There's no exact formula, right? And even the pros can get investing in stocks wrong from time to time. So again, we also have bonds. Over the past decade, bond funds have returned 40% on average. Nowhere near the growth of the stock market, but the bonds have safety that stocks cannot offer at all. If you invested $10,000 in the bond market, excuse the typo, a decade ago, that investment would be worth $14,000 today. So nowhere near if you invested that $10,000 in the stock market, it'll be worth $26,000 today. If you invested that $10,000 in the bond market, it would be worth $14,000 today. So obviously a big difference there in terms of return, but bonds tend to be a lot safer. And for that safety, you got a lower return. What are some of the pros about investing in bonds? A lot less volatile than the stock market. Between 2005 and today, let's call it, the stock market has hit numerous new lows, right? With the bond market hasn't hit lows over those 15 years, and it's just because a function of how bonds are. They're very stable. You're entitled. It's actually a legal agreement where you get cash flow payments, and then you have a claim to assets. So there's not that volatility because it's a lot more secure. Those are some of the pros. Bonds also have credit ratings. So if you want a safe bond, you can invest in a AAA rated bond like Johnson & Johnson, for example. If you want a little bit of a riskier bond, you invest in an oil driller in Texas or something like that. Some of the cons for investing in bonds, they are less liquid than stocks. If you own bonds and you decide that you want your cash back today, there isn't the guarantee that you would be able to sell that investment at what's known as a market or fair value price as with the stock market. And that's because bonds are not traded on an exchange. They're traded over the counter. So there's just not that much liquidity. You also need a larger amount of money to initially invest in bonds because it's a $1,000 par amount. So whereas with the stock market, if you've got $100, you can buy 4 shares of a $25 stock. There are no $25 bonds really. All bonds have a face value of $1,000, and they usually trade somewhere in plus or minus a couple percent. What is a mutual fund? So a mutual fund is a managed investment fund that pools money from many investors to purchase securities. So you've got some cash and you say, I don't want to play the stock market on my own. By buying into a mutual fund or investing in a mutual fund, you're basically giving that cash to professionals, and they are pooling it together with other people like yourself, and those professionals will manage that money for you. So with a mutual fund, you rely on professionals to pick specific investments from you, which limits the chance that you would make a rookie mistake. What is an index fund? You've probably heard a bit about index funds. Index funds are a type of mutual fund that attempt to mirror the return of a specific index. So it could be the S&P 500 if it were a stock index fund, or the Nasdaq 100 for a stock index fund, or the Barclays Lehman Ag for a bond fund. And those are some big indices that measure markets, and index funds try to track those returns. So, in terms of stock markets and bond markets, what impacts the stock market and what impacts the bond market? First and foremost, sentiment. What do I mean when I say sentiment? Just how investors feel, right? And how investors feel is how investors feel is a function of what's going on in the financial markets, what's going on in politics, what's going on in the real economy, and so on. So a lot of people who play the stock market on their own, play the bond market on their own to a lesser degree, I guess. When the market feels really good, and you see on the news every day, we're at a new high. People say, "Oh my goodness, I want to buy stocks. I want to buy stocks." Excuse me. And then when the market is at a low, and you see that on the news every day, think back to March, or back in 2007 and 2008, and the market's hitting new lows every day. People think, "I want to sell stocks. I want to sell stocks." That's not the way to go. Keep in mind that markets move on sentiment. Sentiment is a function of what's going on in the real economy and the real markets, which is a function of information. And retail investors tend to be the last people to know anything that's going on in the market. So by the time you or I or any retail investor knows that the market is doing really well, all of the professional investors have known that for probably a couple of weeks, and they've already been buying stocks. So when you pile on, you're buying stocks at the top, right? And you never want to buy something at the top. You want to buy at the low, and you want to sell at the top. Inversely, when things are going bad, you think back to March. The markets hit the lows in, I think, March 13th or so. But from middle of February, there was some chatter out there that this coronavirus thing could be really bad. Excuse me. And the market started tanking from the highs. Pre-summer, the highs for the market were in February. And by the time news got around to the retail investor that, hey, this thing is going to be really bad, it was after 2 weeks of, markets are falling all over the news. And people started to panic then, and they sold their investments. What happened then? You sell your investments at the low, and the market has rebounded 50% since then. So again, it's not good to try to time the market. You don't want to do that. And markets move on sentiment. So what do you do knowing all of that? Warren Buffett, who is a very smart guy and who has made a lot of money in the markets, his quote, which I think is very, very accurate: "Be fearful when others are greedy, and greedy when others are fearful." And just to summarize it, don't attempt to time the market. Just make sensible buy and hold decisions, because over the long term, the market always goes up. What else impacts the stock and the bond markets? Politics. First off, it is a total falsehood that the market tends to do better under Republican administrations and the market goes down under Democratic administration. That's just a total falsehood. If you look back, you can look back through the years since Herbert Hoover, who was a Republican, FDR, who was a Democrat. You think about how the market did under Obama, totally outperformed what the market did under Trump, and so on. So I'm not saying that the market doesn't do well under Republican presidents. I'm just saying that it's a falsehood that the market does not do well under Democratic presidents or administrations. Speaking at a high level, the stock market tends to perform better when there's an easy money policy, which means the Federal Reserve has interest rates that are fairly low, like right now. When there's less regulation, that allows for companies to operate free of rules and burdens and so on. When tax levels, both corporate and individual to some degree, are lower. And the overall economy is healthy because when unemployment is low, people spend more money, resulting in higher corporate earnings, which should result in, and companies paying back their bondholders and share prices going up. When there are less taxes, obviously more revenue goes to the bottom line, and the same thing happens. So those are some of the things that impact stock and bond markets. That's all that I really had to go through today, or all that I had in my notes for today. I'd be more than glad to take any questions if anyone has questions or comments, or if someone disagrees with something that I said. Glad to hear that too.
Sure. Thank you so much for all of this information, Shamba. I was taking a whole lot of notes, 3 pages worth. So
Awesome.
I definitely, you talked, a lot about 401k for people who have business. 401k for people who are working for a company that's able to match it. But can you
Yes.
talk a little bit, or are you able to talk about, because a lot of our viewers are entrepreneurs, right? And so they don't work for another company. They are the corporation.
Right.
What would you suggest for those people would be helpful? Because we still need 401ks too, right?
Right.
Do you have any suggestions for entrepreneurs about 401ks?
My suggestion is that when times are going well, always pay yourself more. And that's what a 401k match is basically. A company says, I've got excess cash and I am going to pay my employees a bit more. And as an entrepreneur, there are going to be good times, like in any business, large business, small business, there are good times and there are bad times. And during the good times, pay yourself more and consider that your 401k match.
Yeah, that makes sense. And there are tax benefits, right? I think
Yes,
got to bring that the accountant on, but
your 401k grows. The 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 cash that you invest is pre-tax money, so it's $1 being invested as opposed to after-tax money. Assuming you're doing fairly well and you're in the 40% tax bracket, that's a difference of 40 cents, right? So it's $1 invested versus 60 cents being invested.
That makes
we
sense.
always pay our taxes, but as long as if we can get away with not paying too much,
we won't touch that one, but about people not paying their taxes.
Yeah.
But no, that definitely makes sense. As an entrepreneur, I know I'm always trying to find ways to lower my overall, my tax amount that I have to pay at the end of the year. I'm always cringing. Like November and December for me are always like, oh my gosh, what are my taxes going to look like when I get to the other side? I hope that it's not crazy. And my tax accountant is always like, well, why don't you just put some money into your 401k, and that'll help to lower your overall tax amount that you're being taxed.
Absolutely.
And you never know, that might be what our president was doing. So he has a nice 401k that he's sitting on somewhere. So
maybe.
Thank you for that. So my next question that had come in was about Bitcoins, because you didn't talk about Bitcoins, right? And that's now like this new world of currency as well. And so can you talk a little bit about what a Bitcoin is, and then also can you, I guess, give what I guess the comparison between a Bitcoin and the stock market, because they aren't the same, right? But they seem like they work very similar.
They are not the same at all. And the reason that I did not touch on Bitcoin, I am not a fan of Bitcoin, and I will tell you exactly why. Bitcoin is a currency, right? Theoretically, that's what it is. You use Bitcoin to pay people. It is a currency. So betting on Bitcoin is the equivalent of investing in the US dollar, or investing in the Mexican peso, or investing in the in the Canadian dollar or something like that, which it is a tangible asset in as much as you can touch it theoretically. A currency is, but it doesn't provide any income, right? You buy a Bitcoin, and you are basically, all you are doing when you buy a Bitcoin is hoping that tomorrow someone else will be willing to pay more for this Bitcoin. With no thesis at all, that is your only hope. When you buy a stock, what you are saying is, I am going to invest in, let's say, I'm going to invest in Lockheed Martin. Let's say that, and I'm going to invest in Lockheed Martin because the U.S. government is going to continue to buy F-35s, and Lockheed Martin will continue to make money and pass to their shareholders. With Bitcoin, all you're saying is, I'm buying Bitcoin because I think someone is going to pay me more for Bitcoin tomorrow. Bitcoin also has wild swings in value. So you're taking on a lot of risk for something that you can't really put a finger on what the real value is. And if if I had one share of Lockheed Martin, I can go to a stockbroker and say, the market price for Lockheed Martin is $360. Pay me $360. With Bitcoin, it's just kind of all over the place. And again, I just I don't think it makes too much sense to invest in a currency that isn't backed by a country, that may never really gain traction, that you can't walk into Macy's and say, hey, I'm going to pay with a Bitcoin. It just, to me, I'm not a fan of Bitcoin. And again, it's been very volatile. Every investor has their own risk profile. My risk profile says don't invest in Bitcoin.
Got you. Yeah, I know there's been a lot. That's a big topic, and maybe we might have to bring you back when we have some people who are high on the Bitcoin side, because it gets really dicey when a lot of programs have been started. A lot of people, I've seen the Bitcoin when it was like almost nil, and now it's like, all of these couple of thousands of dollars. So people are, and then they're trying to, similar to like a PayPal or other forms of payment. They're trying to make Bitcoin a means of payment for things. So they're trying to incorporate it more into the mainstream of what we have.
That is correct. And maybe someday, excuse me, it catches on and it becomes a real form of transaction and payment. But
Mhm.
right now, it's just way too murky and not transparent and not liquid. And again, when you buy Bitcoin, it is a total speculation. All you
Mhm.
are saying that tomorrow, I believe someone else is going to buy this Bitcoin for a higher price. And the reason why it somewhat moves with the market is because all risk assets tend to move together. And a stock is a risk asset, just like a bond is, just like Bitcoin is. But Bitcoin is way at the top of that risk spectrum. And
Mhm.
when investors feel good, they want to take risk. So
Mhm.
when people are feeling good, the stock market goes higher because they want to take risk, and Bitcoin goes higher. But
Mhm.
I just don't think it's a real it's a real it's a real investment.
Got you. Okay. I definitely take notes of that. I'll put it down in my notes. I have two more questions for you. So you talked about like volatility, and with a lot of businesses, how, especially in this current market, and being in a depression and recession, and what happens to someone who has money invested in stock for a company that goes bankrupt?
So if you have money invested in a stock that goes bankrupt, you bankruptcy means that you cannot bankruptcy means you can't pay your debt holders. Basically, that's what it means when you're bankrupt. You say, you know what, I need to reorganize because I owe too much money. My business formula just isn't working out. If you look at the pecking order, an IOU, which is a bond, a company has to pay their IOUs before they give any money to their shareholders. Bonds are senior to equity. And if a company can't pay their bonds, which is what it means when a company files bankruptcy, they can't pass anything on to their equity holders. So if you own stock in a company that goes bankrupt, theoretically that stock is worth nothing. I know there's been a lot of talk because I guess Hertz went bankrupt, and even after they went bankrupt, the stock price went back up. But the stock price went up after it had bottomed, and a stock price is a theoretically it's a discount of all of the cash flows that you expect to get in the future. So after Hertz had been bankrupt, they were reorganizing, and equity holders were basically saying, okay, once they wipe away all of this debt, they'll operate better, and maybe in the future they'll be able to pass money to their shareholders. And that's why a company like Hertz may have seen an initial bounce in their share price, but that is not sustainable as long as that company is in bankruptcy.
So that's good to know. So it's good to if you are investing, it's good to know. So I guess if I have stock in something and I hear that it is that they just filed a chapter 7 or a chapter 11, I need to go and take my money out right away because it's about to start plummeting,
Yes,
basically.
and at that point, again, remember I said markets tend to work on information,
Mm-hmm.
and by the time we know that a company is filing bankruptcy, a lot of um, a lot of investors probably already know, or professional investors already know. So
Mm-hmm.
the share price will reflect the fact that bankruptcy is on the horizon. If you look at Hertz again, for an example, the share price of Hertz probably bottomed before they officially filed for bankruptcy because people saw when they announced that they couldn't pay their debt holders or they were trying to renegotiate. People saw that, and equity holders said, you know what, that means eventually there'll be no money for me. And they started selling that stock. So a company like Hertz, the stock would have bottomed before they even officially filed for bankruptcy.
Mm-hmm. So when saying that, right? So I know you talked about, what type of things influence the market, but can you share maybe some, well, two questions now that I have because you just brought up one. One is, so is it better to do your stock yourself or to find a company to manage your stock for you? And um, let's start with that question first. Should you manage your own stock or should you find a company to manage it for you?
I think unless you have a really good feel for the market, it probably makes the most sense just to invest in an S&P 500 index fund. And I say that because instead of betting on any one stock, when you bet on the S&P 500, you're basically betting on America's economy. And look back over the last 200 years or so, you never really go wrong betting on America's economy. So if you put money into an S&P index fund, you are betting on the entire American economy. Whereas if you put money to if you buy Hertz stock, or if you buy Beyond Meat or something like that, you're basically betting on that one company, which is just a tiny fraction of the American economy. The American economy always does well, but that doesn't mean that every stock always does well. You think about Kodak, for example, right? Kodak was once one of the greatest companies in the world, and where's Kodak today? And there's so many other companies like that, American Steel and so on. The market evolves because the economy, we have people who are always thinking and looking for the next thing in the economy. So always, I think it pays to bet on the economy overall, as opposed to just betting on one stock.
Thank you. And my last question is, what's the best way to choose a stock to invest in?
The best way to choose a stock to invest in, I think that you need to a company that you believe in. For example, let's say I invested in Google once upon a time because you don't even say, hey, let me search for something. You say, hey, let me Google it, right? Imagine what your life would be without Google, right? And when you think of companies like that, I think you can discover some good companies to invest in. For I think they're companies that also pay dividends, which can help during a volatile market. A company like Verizon, for example, pays a good dividend, which means regardless of what goes on in the broader stock market, as long as Verizon is making cash, they are going to pay dividends to their shareholders. And if Verizon pays a 5% dividend each year, it means if the stock market goes up 5% and you own Verizon, you actually make 10%. If the market stays flat, you make 5%. And if the market goes down 5%, you're flat. So I like companies with dividends. They tend to be more mature companies, which means they aren't growing as much. And when growth is a part of sentiment, growth stocks may go up at a faster clip at times, but they also don't pay dividends and they go down at a faster clip when the market doesn't feel well. So I like stocks with dividends, and I like stocks that actually play a real role in your life.
Hmm. I like that. I definitely like that. I'm definitely going to add Google and Verizon to my list of stock options,
Awesome.
for sure. And I hope we have carte blanche to be able to send you some questions that we have for people who might be joining us a little bit later. But we want to thank you so much, Shamba, for joining us, for sharing all your wealth of knowledge. This has been very helpful, I know, for me, and I'm sure a lot of people who have joined us today and who will be joining us throughout the week, who will be watching this on replay. This trying to get back to Black Wall Street is, no easy feat. And the only way that we can get there is through educating ourselves and, and working with people who are experienced in the community. So again, thank you. I really appreciate you. And I hope to have you come back, like I said, to do some more talks about finances and getting us in shape. So I really appreciate it.
I'm glad to help. The cash is out there, the potential's out there. Let's get our share.
Awesome. Thank you very much, Shamba. Have a great evening, everyone. Again, we hope that you will join us on June the 18th, 19th, and 20th of 2021. And follow us on JuneteenthNY.com for any updates on things that we're doing. So thank you and have a great day.